Okay, folks, welcome to Volume 4 of the continuing series, The Inner Circle Traders Market Maker Collection. This is Volume 4 of 12 installments in the continuing series. And this particular volume was going to focus specifically on advanced institutional order block and market structure analysis. Now, I've, I've released an idea on how I interpret the market and its market structure over the last 2 decades as it relates to the commodity market, currency market, and now uh, spot FX. And because of my exposure to the institutional aspect of trading, I was able to glean a lot of insights that isn't readily available to the retail universe. Now, uh, before I get into this, I want you to understand very clearly that it's not essential that you understand this to be profitable. Okay, what this does is gives us a behind the curtain view, as it were, to why the markets are doing what they're doing. And for those that have an insatiable need for needing to know why something works, and because of my obsessive compulsive disorder as a human being, I had to know that myself. So going forward in your trading, if you aren't at that stage now, okay, and you're profitable, um, out of sheer morbid curiosity, one day it might just, you know, prod you to, investigate, if you will, why certain market truisms are what they are. Why do markets take on a persona of retracing into previous structure, order blocks, and why do they react as they do in your charts? And by understanding the mechanics of the institutional side of how orders are placed on large scale entities like banks and large institutions, you'll understand very clearly why the markets ebb and flow higher and lower, where they retrace to, where they expand to, and then pause. All of those characteristics will become clear to you once you do an in-depth study of what price action has done on the left side of your chart. You'll have a greater understanding of what's to come on the right side that's unknown. Okay, and a lot of the study that we will be encouraging in this volume and in volume 5 will be on a hindsight basis. Now, I know a lot of folks are um, uncomfortable with the word hindsight, but you have to understand you can't arrive at a greater understanding of something until you have seen it over a period of time, exposure repetitively. Okay, and what it does is it trains your eye to see the characteristics that are inherently generic to this repeating phenomenon. Now, the phenomenon I'm referring to is the order block specifically. Now, it's not enough just looking for a down candle to buy into and an up candle to sell into. There's got to be some framework around those ideas. Otherwise, it's simply just, it's chaos, and you're just going to be in there frustrated because you're looking for something that doesn't exist. Okay. So, also, let me toss this out there. I want you to be aware that I am cognizant of the truth that just simply looking at the charts on the left side in great detail, in hindsight. Okay, for instance, if you study the market in back data, looking at going over old price swings and such, say you do it for 2 or 3 years worth of data. Okay, I am not going to sell you the idea that's the equivalent of having 2 to 3 years experience. Okay, that's perpetuated by the retail universe. Okay, what it does is it just builds a familiarity to a concept. It does not give you experience. The experience will come from you trading on the right side of the chart in unknown data. That's where the real learning comes from. Do not be lulled into believing just simply because you're scrolling back through old data that all of a sudden now trading is going to be easy for you. Okay, or so-called advanced pattern recognition trading or harmonic trading is going to be easy for you because of that. No, it's not. The learning, you haven't even began yet, because it has to happen from the right side of the chart. And that's what my video series, this one and all the ones prior to it, have been really trying to uh, uh, perpetuate in you, is the understanding of the expectancy of your learning is not going to come from what I show you in examples. It's going to come from your exposure of what happens on the right side of your chart going forward. Okay, those are the life lessons as a trader that no mentor can share with you. We can't do that. Okay, my mentors couldn't do it with me, and I'm telling you, I'm not going to be the one that does it either. Okay, so there's a learning curve that each of us have to endure, and some of it's going to be quicker than others, and some other things will be a struggle. But if you do not give up and you maintain a steady forward momentum in terms of just plowing through the data, plowing through the exercises of getting used to seeing it, understanding time of day, day of week, time of year, seasonality, and understanding the large flows based on COT influences and commercial traders, that will all synergize into a greater understanding, and you'll see when it is specifically that you want to be doing your trading. I can't force you into this is how it's going to be every single time, because there's going to be minor variations and deviations from the overall ideas that I'm sharing in this particular series, because we are looking at the concept of institutional order blocks. There has to be a understanding that there still remains a gray area. It's not black and white yet. Okay, black and white comes from you doing your trade and exiting the trade, and the final results are what they are, black and white. Okay, while we are trading, we're always in that gray. We can't get out of the uncertainty of whether or not the trade is going to be uh, as we expected prior to hitting the enter. Okay, so I put all that out there to understand. I understand that you are expecting specifics in terms of exactly this, exactly that, and it's always going to look like that. Okay, um, it's not going to be like that. There's going to be some minor deviations, but when you understand what's going on behind the scenes and why institutional orders should be, flooding the market, and when they should be scaling out of those trades, then you'll have a greater understanding of what order blocks are going to be good, what order blocks should be avoided, which are low odds or expectancy in terms of profitability, and which ones are high odds of being profitable if traded. Okay, and that's really what we're going to try to be focusing on specifically in this module. And then we're also going to be dealing with when we're wrong, how that is still advantageous to you as a trader, and not to be fearful of taking the next trade based on your failed order block. Okay, and when we talk about mitigation, not only will we be mitigating our own losses in volume 5 of this series, but we'll also learn how large institutions inject um, liquidity in the marketplace, and we're going to be hinting at some of those ideas in this module here as well. But more specifically, we're going to be looking at qualifying and quantifying solid, uh, very trustworthy order blocks in your trading. All right, the ICT institutional order blocks. Now, order blocks are specific candles or bars that, when properly viewed in institutional context, they can highlight smart money buying and selling. Now, if you have been studying price action of any length of time, there has been this movement, if you will, that's dubbed a supply and demand. Now, while I agree there are certain aspects to the market influences, okay, that we see in price action that are governed by supply and demand factors, that we honestly, I believe, and I 100% subscribe to the idea that we as individual traders cannot arrive at the fundamentals on the level that the institutions do on a day-by-day basis. Now, we can have a long-term macro view on that, and that's very advantageous to our trading if viewed in that context. But if you're looking to trade on a daily based on fundamental data, I believe that if you're profitable, it's only because of coincidence. It has nothing to do with fundamentals can't be timed on a short time frame. Okay, that's basically what I'm saying. Market reports and market drivers that come out on a monthly basis, like PMI and non-farm payroll, those things are injections of volatility, which are useful to us as traders. But to ascertain whether or not they're bullish or bearish for the market, to me, I think it's a fallacy to believe that any one particular trader can do that and disseminate that information and discern, and in a realistic amount of time when it's released, how to use that data intraday or on a short-term basis to take profits out of the marketplace. But I do subscribe to the idea that fundamentals do have its role in large macro trends, and those large macro trends okay, are going to be governed by institutional trading. And because my focus has always been specifically aimed at following what those institutional traders are doing as a collective whole, I don't need to worry about the fundamentals because I've already let those individuals that know more about it than I do and have a lot more vested interest in knowing what those fundamentals are, okay, to tell me what they're doing with their money. Because if I can discern what they're doing with their money, I've just really removed a whole lot of needless study and bank report reading and such. I don't need to worry about all that stuff. And you may want to believe that that's useful to you, and I'm not going to argue against it if that's what you want to do, with your time, and you want to spend that, trying to wade through all of the countless reports and number crunching that's attributed to fundamental data. That's not for me. Okay. But if you want to do that, it's your cup of tea. Go right ahead and have at it. Now, apart from commonly used supply and demand zones, order blocks are very specific levels. Okay, they're particular price levels that can be refined to lower time frames to exact price levels, not broad range or zones. Okay, there are countless. If you go on the internet and just do a Google search on supply and demand zones and trading supply and demand, you'll see a lot of overlapping ideas, okay, amongst the mentors or teachers in that realm. And I have, gone through some of it and looked at it, and while some of it does have advantages to just simply understanding what they're trying to hone in on, whether it be a bullish or bearish environment, okay, around a particular level. I believe that's good as a starting point for new traders because I think, that's what, if you look at any mentor, I think they get the recurring question is how do I know when to buy or sell? And if you can understand when is a good time to be a buyer and not so much a seller, that's like a lot of the game, you know, you know, uh, right there for you, solved for you, because if you can only focus on one side of the marketplace and only do one type of thing in that environment, for instance, if you're looking at a so-called supply zone, and if you're looking at bearish, for instance, harmonic patterns, that would be advantageous for you, okay? But not looking for bullish patterns, okay, is the strength in that understanding because you're in an expected area of supply where the market should be deemed overbought, not because of an indicator, but based on what's, you know, the previous swing has moved into an old area of market structure. When that has happened, what we do, we anticipate that as an area where we may see correction, a reversal, okay, and a less likelihood of an advanced move in higher prices. So by focusing on bearish patterns, and it could be as simple as a bearish divergence, okay, in a MACD if you're an indicator-based trader, then suddenly your indicators will work. Okay, an RSI, stochastic of that nature, CCI, all those types of things when you're looking for a premise based on that mathematically derived indicator. If it's framed around an area of supply, okay, then yes, I agree that that would be, a basis for a profitable short with all those ideas associated with it. Now, my work, okay, while there are similarities to some of it, okay, mine goes to the nth degree in terms of precision. Okay, I don't rely on simply a zone. I don't look at a broad brush idea of a range. Okay, that's commonly referred to as a supply and demand zone. Okay, I've always been tickled to see these so-called supply and demand zone traders. Okay, they'll put their boundaries on the beginning, level and the outer level of where they anticipate the selling scenario to happen, but none of them really come down to the entry point of where you're getting in at. Okay, it comes to that still gray area, and the fog's still there, and my beginning point in understanding all of this, before I was involved in the institutional side of trading, I understood that the common swing point in market structure, which is a low that's surrounded by a higher load candle on either side of it. Now, if you're familiar with MT4, you'll know that there's an indicator that's plotted, and it's called a fractal. Now, the fractal indicator to me is useless in terms of the short term, because it's requiring at least 5 candles to form before it identifies a fractal low or swing low, or a fractal high or swing high. Um, I don't require that. All I need is a level that I anticipate a turn to occur. That being, for instance, if it's a support level on a higher time frame, what I'll do is I'll start anticipating a daily time frame on a daily chart, a low to form. So in other words, if today is lower than yesterday, and then tomorrow when we trade and we close, as soon as we get a higher low, right then and there, the very next day, I'm trading with the anticipation of higher prices, because I understand that that is a swing low, framed with the pretense that there is an idea of anticipated or expected support based on a higher time frame premise or top-down analysis. Now, that's not the scope of this teaching here. I have all that explained in other resources on the innercircletrader.com's website. If you go into the tutorial section, there's a plethora of information based on top-down analysis and all the the broad range ideas that I will be just referring to and passing, as I'm discussing some of the finer details here. If I was to revisit all those things, I'd be looking at a course that would be 50 to 60 hours long, and you'd be inundated with information, and you really probably wouldn't glean that much from it because it would be just information overload. This particular course and series is really aimed at those individuals that have been following my work since 2010, released specifically just on the foreign exchange market trading. So all those resources that are being specifically aimed at FX are really being tied together with this one. So if you're starting here, you're really missing the point of all of it. You got to go back and through. There's no shortcuts. You got to go through all the old stuff. Okay, but having the understanding of specific levels, price levels, okay, and identifying where the institutions are actually doing their trading, because I believe you can ascertain that by looking at a price chart. That the advantages and why I moved from institutional trading and left that industry and moved into the retail world is because I could match up when the actual orders were going in and where that looked like it would be recurring in the price charts. Okay, and the common denominator is this. It goes back to the sheer volume of institutional traders and bank traders. Okay, the volume that they use when they're trading, they're not trading standard $100,000 leverage contract type specifications like we do. If we're trading a standard lot in foreign exchange in the euro, 1 pip is worth $10 per point. That's not what you're seeing in the institutional realm. They're trading many, many, many times larger than that. Okay, and the volume that is essentially their trades, they have to be entered when the market's moving against their intended direction of profit. Okay, and what that means is, in layman's terms, is they have to be buying when the market drops, and they have to be selling when the market rallies. So when I was looking at the orders that were being entered, there are a large similarity to where that was occurring at on the price chart in relationship to overall market structure. And market structure, as it was taught to me by Larry Williams in the 90s, it was just like someone took the blinders off me, and I knew clearly what it was that I was missing all along. And it still, um, you know, can be perceived incorrectly. So let me toss that out there as a caveat there. The bottom line is, you are still a human being, and you still are likely to see something that you really want to see, and you can argue and build the idea that it's there when it's really not. So understand, what I'm sharing here still isn't the holy grail. In other words, ICT hasn't cracked the perfect, every single time I get in a trade, I'm going to make money. Okay, do I have a 90% accuracy? Yes. Do I lose money? Yeah. Do I have losing trades? Yes. Do I have strings of losses? Yes, I do. Okay, but I don't fear them, because I understand that even though I may get it wrong once in a while, the reoccurring phenomenon will happen again enough times for me to recoup the loss and to move back to new profits. Okay, so that's the benefit of understanding this stuff, because you don't have to worry about jumping ship and changing ideas and systems. You can trust the fact that this stuff will work, it will repeat. It's like buses. Okay, it's like the mass transit administration. If you miss the bus, just wait around because another one's coming around. Okay, and this is how it is in the marketplace. Opportunities are just like that. One missed, there's another one just around the corner. Now, the higher time frame institutional order flow is critical to selecting high probability ICT order blocks to trade on. Now, understanding the current trading range, okay, is equally important in relationship to detecting the actions of the smart money traders or institutions and banks. Now, what am I talking about here? I'm specifically aiming your idea of study in higher time frame order flow. Now, what is higher time frame order flow? Well, that's the monthly, the weekly, the daily, 4-hour. And if you really, really, really have to look at anything less than a 4-hour, you're leaving the higher time frame premise and you're moving into an intraday basis. Okay, your study really should be focused more on what are these higher time frame trends, if you will, or directions most likely reaching for. Because if you understand that and focus specifically on that and trade inside the ranges that is identified on these higher time frames, it will remove a lot of the uncertainty that plagues most traders in their hunt, if you will, on trade setups and on directional bias. You don't need directional bias to make money, but it really makes it a lot easier in terms of getting into explosive moves and holding them for extrapolated price moves and price swings that go well beyond what you're expecting in the beginning of the trade. There is the understanding of trading inside the range, which is a concept that I taught years ago, and using the concept of an L range and a 7, there those ideas. Okay, and again, I'm counseling you to go back through my old material. So if all you cats that just started warming up to ICT and you think you're going to get to the end game by watching this series, you're missing, and you're not going to learn anything that you would have learned if you understood all of the the prerequisites, if you will, to getting to understanding what I'm sharing in this series. So having that understanding of the current range that we're trading in and higher time frame premise and directional bias that's arrived at by institutional order flow on the monthly, the weekly, daily, and no less than 4-hour. Okay, by having that discerned, okay, how do we do that? Well, we can look at market structure. Okay, where are we at in terms of the price swings? Where are we at in terms of the moving averages that we've taught that help us keep our focus on one side of the marketplace, those being the 18 and 40 EMA and the 9 and 18 EMAs. And again, we are not looking at crossovers of those moving averages. What we're looking for is the stacking and the opening up of those two averages. When they open up and widen and they're pointing in the same direction up, we are under the assumption that that is, if it's on a higher time frame, that is a bullish buy program. In other words, the order flow will be moving higher. Because of the higher time frame chart, if it is moving higher, trends on a higher time frame tend to stay in those directions for a good deal of time, and it takes a lot of influence outward to change those tides and make it go the other way, and vice versa. If the EMAs are pointing lower and they're opening up, we understand that that is an institutional sell program. Okay, and order flow will be going lower, and looking for bearish order blocks in that environment, okay, would be advantageous. Now, what are the common characteristics that are among high odds ICT order blocks? Because I get a lot of questions as to, okay, well, I'm looking at this order block and it didn't work. So the frustration starts to build, the uncertainty, is this something that's, tradable? Is this something that's useful? Okay, and it is, but you just learned it this year, okay? Or last year rather, in 2013 I introduced it in Sniper series, and in 2014 I gave the precision trading series. So yeah, it's a relatively new concept to most of you. So don't be discouraged really if the fact that the notion of you seeing it with a high probability every single time. Okay, if that's not there yet, don't be discouraged by that, because again, I had to grow into my appreciation for them as well. Okay, because what I was seeing in the institutional realm and then what I was seeing in price charts, they had to tie together, and it took a time for me to trust what I'm sharing with you. It took time to do that. So understand that it's going to take a little bit of time. Okay, but when you do put the work into it, it will be advantageous beyond all measure. Now, what is it specifically that builds the case for a strong, high odds bearish order block? Well, there's going to be a stop pocket, okay, that's going to be resting just underneath an ICT bearish order block, which will be above a nearby swing high. Now, what am I saying there? If we are anticipating a range, okay, that we have been seeing a retracement higher in, okay, in other words, there has been a move lower recently, okay, and I'll let you determine what recent means based on the time frame you're trading. But let's just say we're looking at a 1 hour chart. If the 1 hour chart has recently had a price swing move lower, and now we're um, having a retracement inside that range that moved lower, okay, we understand that pulling a fib from that high to that low, we would anticipate an ICT optimal trade entry to form a likely barrier as resistance around the 62 to 79% retracement levels, with an ideal 70.5 fib as a sweet spot, focusing in on an area where resistance should reside. By itself, that means nothing, okay? But ideally, the optimal trade entry should be above a short-term swing high just to the left of where you would anticipate the optimal trade entry to form and the confluence of a bearish order block. In other words, there should be a bullish candle that you're aiming for as a bearish order block, okay? But that order block will be further validated if it lines up with a fib optimal trade entry, if it's between 79 and 62% retracement levels from the high down to the low, that price swing that we're just using as an example. And again, this is the reason why I'm telling you guys to have the understanding of the previous material, because I'm not going to give you all of those details and give you the shortcut to the front of the line. Go back through the old material. It will teach you and build this framework that you need as an understanding. But if you have a short-term high, okay, in the retracement, okay, and while it's retracing inside of the larger price swing lower, there may be a smaller little retracement back lower, okay, that sets up a short-term high that will be below the ICT bearish order block. When that occurs, okay, traders will see that as a potential continuation and move lower. And what they'll do is they'll get short there. And what that happens to do is it provides liquidity. And what will happen is the institutions will see those orders stacking above that short-term high. What will they be in the form of? Buy stops, protecting their shorts, because they're going to believe that the market's going to continue lower based on that rapid drop down that they saw from the high to the low that we put a fib on. We understand it's going to probably most likely be a deeper retracement and move back to the existing bearish order block, which would be the bullish candle prior to the move swinging lower over the overall price structure. The institutions will put in buys to run those orders, okay, and what will happen is they'll put in a good buying influence, okay, and what will happen is once the market prints at that high, at that swing high, all of those orders that are above it and resting buy stops will become market orders to buy at the marketplace, and that will further drive price higher. Where is it going to drive it to? To the bearish order block, where they will have resting pending short orders to get short, selling out of what they use to get into the marketplace, okay, to drive the stops out, but also now to assume, okay, and accumulate more shorts at the bearish order block. Okay, so what am I saying here? You're going to see a confluence of optimal trade entry overlapping with an order block, and there has to be a swing high for a bearish order block prior to it reaching the bearish order block. Okay, in other words, in terms of range of pips, because I know some of you are probably writing it down. Well, how many pips will it be? it depends on what time frame you're looking at, because it could vary. Okay, and once we show some examples, you'll see clearly what I'm referring to. But we were talking about it basically in the last video, when we mentioned true day, where the markets reached to in the previous session, previous day, previous week, previous month, okay, where they reach into the previous range to run stops. That has to be attributed to high odds order block selection, because there are going to be times when an order block doesn't have to have those stops to run, and it'll be outstanding, and that's fine, that's great. Okay, but if you focus on the ones that do have this scenario, you're going to find that they have an absolute barn burner of result in terms of having a profitable setup that resides at these particular bearish order blocks. And much like everything else that I teach, the concept is reverse it, and it's the same thing for the other side of the spectrum. For an ICT bullish order block, okay, stops will be resting just above the order block, okay, and which will typically be right below a nearby swing low. Now again, assume for a moment that we had an hourly chart, and we saw price find some support and had an impulse move higher. Okay, in other words, we rallied up pretty strong and fast. And then now we have recently started retracing back lower. We would pull a fib from the low that it had made at the implied support level up to the reactionary high, and as it's retraced inside that range, okay, we would anticipate an optimal trade entry, confluence, and a bullish order block. But what makes it strong is that there will be a short-term low form in the minor retracement back lower. Okay, it'll retrace a little bit and then bounce again a little bit higher, but not back to the old reactionary high that was made for that impulse move. Okay, and again, I'm going to give you examples of this in chart form, so if I'm confusing you now, just understand that these are the notes that you should have in your collection, okay, because this is what we have to to build the idea of, to ascertain high odds order blocks. But if a short-term low or swing low forms, okay, in the overall retracement of that impulse move off of a support level, okay, then what we described as the bearish order block high odds candidate will be reversed here. In other words, the institutions will put a very large interest in going short on that particular market or asset and drive the market to where the swing low and subsequent sell stops would be. And because those individuals that would see that short-term low, they would say, okay, well, the price action moved really, really hard. We've retraced. Look, we made a low. It may even make one of those fractal patterns that you see on MT4. I'm not saying you need to have that, but whenever it looks like it turns the corner, bottom fishers will come in and try to catch that low and assume that's the bottom of the marketplace. And when they'll see a minor little retracement, or move higher in their favor, their stop loss will go where everyone knows it will be. It'll be placed directly underneath that short-term low, which will be just above the bullish order block, okay, or the down candle prior to that big impulse move higher. When we have the stops ran out, those stops become sell orders at the market, which will provide more influence to drive the market back down into the bearish candle prior to the impulse move higher at the support level. That's where their pending orders on the smart money or institutional level, okay, will be having to be a buyer, buying up the shorts that they use to drive the market lower and accumulate new long positions before the market starts to have its profit release portion of the price swing higher up. Okay, so again, ICT bullish order block high odds is going to have a confluence of optimal trade entry, 62 to 79% retracement level overlapping, and there should be a short-term low just above the order block inside the overall framework of the impulse move. And what will happen is you'll see the market drive lower below the stops out, re-enter the bullish order block or bearish candle in this respect, okay, and then you'll have what I view as a high odds bullish order block. Now, bearish order blocks reside in bearish market structure and inside of higher time frame sell programs. And again, we've already talked about the idea of looking at market structure. look at the higher level institutional flow on the monthly, weekly, daily, and 4-hour. If it's overall bearish, we're making lower lows, lower highs, and all of the bullish market influences are not being respected. In other words, bullish order blocks are getting blown out. Okay, we are in a bearish market or in a higher time frame sell program, and we can mainly just focus on looking for bearish order blocks to sell into, with the understanding of what we described just above. And again, not surprisingly, bullish order blocks reside in bullish market structure, higher time frame buy programs, and we would anticipate seeing bearish order blocks being blown out and not respected. So therefore, the overall order flow is going to be on the bullish side. So now with all that, let's go into the charts and look at some of these examples of how we can qualify and build confidence around when order blocks are good and when they're not. Okay, let's look at a few examples on how order blocks are qualified and how we can work within particular ranges and trade even with the higher time frame premise to really narrow down high odds opportunities. But I want to give you a couple of examples of trading against the trend too, to kind of like give you a complete view as to what is being suggested here, because I'm not trying to box you into only trading in the direction of the higher time frame. I want to allow you some certain measure of flexibility, because I know some of us have different opposing personalities as it relates to trading, either with a trend or against a trend. But we are looking at the cable. This time frame just happens to be in the July month of 2014. So if you want to look at your charts, you can do that as well. And the idea that we have here is we had a price move lower. Okay, and this inherent wick here, I'm not going to discuss this here because we will talk about this in volume 5, and it relates to mitigation blocks and responsored order blocks that have been taken out. So we're going to have to defer that conversation for another video. But we're going to assume for a moment that you can clearly see this price leg here. Okay, assuming, let's do this. It'll be a little bit easier to teach like that. Okay, now we had a price swing here, drop lower. Okay, and price had made a short-term high here and started to move lower. Now, when we look for order blocks, okay, in a down move like this, okay, we saw a market structure shift. Okay, we had another price swing going lower. We retraced there, came lower, and what we had here was another impulse leg inside of the parent price swing, which is this one right here. Okay, so looking at that, if you take the highest high down to that lowest low right in here, okay, we have optimal trade entry in here. So we would look for at least a minimum of an expected return up to this range, okay, between the 79% retracement level and the 62% retracement level respectively right here. Now, let's remove the fib because we don't need it anymore. We've already ascertained the information that is aimed at looking for that. And the idea next is that we view the short-term high that's in here, okay, as price starts to drop down in there, that little bit of movement is all it's going to take for stops to start stacking above this high. Okay, now where is the bearish order block? The bearish order block is this bullish candle prior to the beginning of the sharp move lower. Okay, again, bearish order blocks are bearish because the bullish up move prior to the move down lower in price, okay, is where the smart money or institutional bank traders are going to be selling into that rally. Okay, remember we talked about earlier, their sheer vastness of their orders requires them to be aggressively moving in an opposing direction of their trade entry. Okay, in other words, they have to be selling when they're looking for lower prices. They have to get into the marketplace as it's moving higher. Otherwise, their fills won't be as economical as they would like them to be. Okay, they're just like us. They're driven by the bottom line, and the bottom line has to be closely watched when you're trading, at the scale that they do. So now, with that understanding, okay, we're going to have the view of the market moving higher, at least to the bottom threshold of the bullish candle, which is this low right here. Okay, so I'm gonna have to move this over here just to grab this trend line here. So again, we're identifying the bearish order block, which is the bullish candle right here. We've noted that there. Okay, you see what we've done? We have now identified a high odds candidate for a bearish order block. Okay, so keeping with the general theme of how I view my own trading as a sniper, okay, we could have our crosshairs at this particular level, minimum threshold on the upside is it has to trade at least to that 171.36 level. It must trade there, okay, to be considered high odds entry for a short. Notice also that we are still inside of the optimal trade entry range in here. Okay, you see that? That's what that box was left there for. Okay, and we also blew out this short-term high right in here. So they did what? Let me ask you a question. What do you think the banks were doing right here? Well, what time of day was that? This vertical dotted line here delineates midnight in New York. Remember we talked about true day? True day is how we view the market activity by the smart money. Okay, how are the banks working on an intraday basis? Okay, what are they doing? What is the business model they're using? To inject volatility, to induce liquidity, which is what we're seeing an example of here. This induction of liquidity, okay, is a result of a stop run, okay, that is clearly framed and repeats all the time. Now this is how they run buy stops on shorts, to take those individuals out of the marketplace and accumulate new shorts. Now they were sellers here clearly because the market had dropped. That's how we identify the fact that they did it. This was their footprint. Okay, so and up in here we have a footprint of the elephant. Okay, the elephant being smart money, that big entity in the marketplace that lumbers through and just cleans house and makes the majority of the money. So with that footprint in the marketplace, now what we do as a sniper, we want to see a revisit of that same activity, because our understanding is what? The sheer vastness of their orders clearly indicates that they are most likely not going to be able to get all of their intended or expected position on the initial time it trades to that price level. Okay, so in other words, we're assuming that we'll just say that 171.40 is a fair assessment for an average price for them. Okay, and without breaking all this down in here and including this over here, which we'll do at a later time in mitigation, volume 5, we'll look at refining greater what institutional pricing is and where they do their dirty work for actual entries and exits. But for now, I want you to understand the framework of what constitutes a high odds order block. The bullish candle prior to the downswing in price is where they sold into that rally here. They sold into that. Much in the same capacity they sold into this bullish candle. All this action up here is what they sold into, running out an old high here. See that? Now, when we see this price leg here, that's the price action that we anticipate. Then you're going to see an impulse leg moving into the range that's defined by the high here and the low here. So when prices starts to move higher, okay, we want to ideally see some sort of minor retracement against that impulse move, okay, and create a short-term high. All we need is a high with two lower highs, one on each side of the high. Okay, that's a short-term high. Once that occurs, we know in our mind that above this high is going to be buy stops, because folks are going to see this down move here, and this is going to be viewed as a retracement and then short. That's how they're going to anticipate that. Okay, and because a lot of retail traders use 50% retracement levels, okay, let's look at this. The high down to the low, okay, here's the 50% retracement level right there, and when you know it, there's where the swing high forms. Okay, and then it starts to roll over a little bit in here. That's what we're looking for. That is the absolute wonderful you know, confirmation that what we're about to see is, you know, carnage on the retail world. Okay, and they're going to blow out the stops here at midnight. We are not interested in this down move here. We don't have any interest in that whatsoever. We could care less about that. We're more inclined to sell if it gets back to this order block after 5 GMT, or what would be viewed as midnight in New York time. So in other words, wherever you live in the world, okay, if you want to view the market like ICT, okay, the way I interpret the marketplace is you have to know what time midnight is in New York. You have to, okay, otherwise you're not going to see what I see, okay, and what I anticipate in the marketplace. So we have two primary focal points: is a price level of 171.36 minimum threshold. It has to trade to that level minimum, and it has to do it after midnight New York time, or 5 GMT in my platform here. And by doing that, okay, what we've done is we have our scope of like a rifle on a sniper's rifle. Okay, that's where we're going to be doing our shorts. If now here's the big you know, payoff for you. It has to have a run of stops here. Okay, so if we blow out stops, as indicated with this little short-term high here, as soon as we gun stops here, which we see it here happening, okay, we know that it's going to fuel the rally up into this order block, propelling them into an area where they could do more selling. And look at the immediate response there. It trades up into that range of this previous order block, and then boom, slams, runs away the other way. Okay, you see that? That is a high odds bearish order block. Okay, and true day down here calling it, you know, hold, and then you see a profitable result as it is indicated in the charts here. Okay, we have a big run on stops here. Okay, and again, we're going to talk about this whole price structure because it's not in the scope of what we're teaching here, but it will be dealt with in volume 5. So we're building an understanding, a greater understanding of what it is that you are hopefully trying to digest when you look at price action. You know, who's doing what at what time. Okay, we have, again, we have 5 GMT, or midnight time frame, okay, in New York. We have an area where we see stops being right here. This is a short-term high inside of the range here. See this just drop down here. Now, why am I not talking about this? Because this is a climax reversal, okay, and climax reversals rarely see a return back to the high. Okay, and again, this will all be talked about in great detail in the mitigation volume. So we have stops, known stops that will be right above this high, okay, and a run up. See that run up here, this little drive higher. Where's the order block that it's reaching for? Here's the bottom of the bullish candle. See that right in here? So between time, which is defined by 12 midnight or 5 GMT, okay, we have a short-term high where we know stops will be residing, a run higher, okay, Judas swing, much in the same vein this was a Judas swing here, lulling traders into believing it's going to go higher, and into an order block, and pour fib up. If I grab the right tab. Okay, so we have this high here and the low prior to it. Here's the sweet spot inside the optimal trade entry. Okay, here's the 62% retracement level, 79% retracement level right in here. So we have one more example of precision, okay, for London Open. Okay, so we have this set up here. Now, interestingly enough, if you look over here, we have another smaller intraday sell that was available for the New York Open with the same area in mind here. Okay, you see that happening, and they sold it again intraday, only down to a bullish order block here where the trade had to be a collapse because it's too late in the day to see any further continuation. Your stop probably most likely would have been in hit intraday if you would have trailed that. This day here, right in here, okay, we have order block right there, bullish order block prior to the move lower. We have an area of, let's get this off here, clean highs. You see that? See how clean that is? Okay, and price running above it. So we have this area right here. So price has to move above where the stops are and has to be in time. So in other words, we have 5 GMT here, we have a rally above time and price, okay, and inside this order block. You see inside that order block. The notion of a reclaimed, okay, or responsored order block, I'll just give you an example of it here because it's staring right in the face. The order block that sent price lower here, okay, see right in here, okay, we returned to this one, but we created another bearish order block right in here. Okay, if you look at how we moved right there, right here's your previous order block. Again, another opportunity in New York session then, and then look what we did here. Boom. Very, very precise. Okay, very, very precise. Just moving above the midnight time frame. Now, the question is this: well, Michael, what time is this move happening? Well, this move here is happening at 5:45 GMT. So it's a little bit early of the London Open kill zone. Okay, my earliest is 6 GMT, so I would have missed the ideal entry here unless I had a pending order. Now, I will tell you this: I do get up around 12:30 to 12:45, around that time frame, to look for the beginning stages of what should be taking shape. And what I'm explaining here is the beginning foundations of how we're going to be doing intraday trading for London Open, and what it is I look for, how do I frame the ideas about the marketplace and what it should do going into London and at least the Frankfurt Open. So we have this area here, may or may not have gotten trade, may or not have caught any of this. And the next opportunity, qualifying bullish or bearish order blocks. Okay, moving on over to the next opportunity here, we have the price swing here, moving lower. We have a bullish candle prior to the move lower. Now the reason why I'm using this level here is because it's also the bottom of the body of this candle. So this is an up candle, and this is an up candle. Even though we have this wick, the body of the candle here, or the opening of that candle, is essentially that same level. So I'm using that. Okay, and also if you look at the body of this candle as well, and look at the bodies, I'm sorry, the wicks of these candles. And this is what we're going to talk about a lot in volume 5, where we start looking at institutional pricing, where they actually do their entries on the institutional level. We have equal highs in here. Okay, what we commonly hear in the retail world is a double top. We don't believe in double tops in the ICT camp. Okay, so we know stops are going to be residing above these highs in here. Okay, and here is midnight time frame, and we would look for a minimum of a move back to that level in here, and take out the low of the bullish order block. I'm sorry, the bullish candle, which makes the bearish order block. Okay, and that would be our price level that we would be looking to get short on. We also have this range in here that would be viewed as well. We have this price swing down here, and using that as our basis, okay, because this could have been very easily viewed the same way as we're describing here. We have a short-term high right there. So stops would have been resting above this. Price moves above. We are clearly in London Open kill zone here. We do even return back to this previous order block and this order block, and stops are ran, making a higher high here and selling off as a result. This being a 5-minute chart, if you went down to a 1-minute chart, you can actually even fine-tune that even more down to this particular price level right there. That's how we can really refine the risk and increase the reward to risk ratio. Okay, moving on to the next example in here. We have, let me draw back up. Okay, we have price in here really not giving us the return to what I would have liked to seen, at least this bullish order block here, maybe even this one here. Did not do that one here. We did see it return to this one, and let's get rid of these and work with horizontal lines and not be so cumbersome. So we have this bullish candle prior to the move lower. So we are inside that order block here. Price structure is from this high down to this low. Inside optimal trade entry in here. And we did trade against that order block. You know, look at all the candles in here, just the highs of them, just tagging against that price level, then moving lower. May or may not have been a good early entry, but using the same vein later on in the same day, we had stops that would have been cleared here. That would have been an early entry if on a limit. In other words, if you had your order already in as a limit order earlier in the morning around Asia and went to bed maybe. If you look at the order block here, bullish candle prior to the move going lower, short-term high, that would be just below, okay, short-term high below the intended order block, that would be bearish. Okay, you see that? And market structure price swing from the high to the low right there. So we have optimal trade entry in here, order block here, stop being taken out here, may or may not have been filled there. You know, fancy dancing around, you know, may not have, maybe not have had an opportunity using that specific entry point. We have a bullish order block here that does reside with the sweet spot in here, which is, I think, is nice. But if you're reaching for that 79% retracement level, which is what you hear me not try to drive too hard, I like to use the sweet spot if I can, but risk permitting, the 62% retracement optimal trade entry level is where I ideally do most of my trades. So again, you can go back through all my other material and you'll hear me say that. It's wonderful, and when I show examples of how the 79% retracement level really encapsulates the high and low of the moves, everyone assumes I'm getting that price. I'm not getting that price. Many times I'm getting this price here, or something in between the 62 and the 70.5 level. I might try to get creative and look for a level in there, especially if it's a round number. In this case, we have 170.90, which would have been a really good opportunity on this particular day. But my point is this: you see how they're running liquidity into the market by blowing out buy stops, okay, causing the market participants that had stops here to be buying at the market. Well, who's going to take the other side of that market trade? The smart money. They're selling it to them, and they're going to hold that position profitably. All right, let's go back out to a 15-minute time frame. It's getting a little messy looking at this. Okay, we have a short-term high in here, range, order block right there, fell just short of it in here, so no trade early in Frankfurt. And then we have bullish order block right here, intraday, right there. We are now inside of the New York kill zone. Short-term high, range, high to low. This is the market structure price swing that you'd have to use. Parent price swing. Price trades up into optimal trade entry. Right in here is your potential entry for the 1300 GMT time and subsequent price drop. Okay, we have price. I think I'm just going to use a little rectangle. Right in here, stops will be resting above this high. Parent price swing, market structure, high, down to the low. See that price swing here? Equilibrium, right in here, halfway through. So you have a price swing high, down to low, then a measured move from high to low. And let me give you an example of what I'm talking about there. So you can see the symmetry that's in the market. So you have this range from this high down to that low. If you look at the range here, it's almost the same thing. So we have very good market symmetry there. Very good symmetry. Okay, see that? Extend that out. Only had one inherent wick prior to move higher. I only toss that in there because I love seeing it when it happens. It's really really outstanding when you have something like that. It lines up with your understanding of where the market should be going. We have a market structure high here, bullish order block, and the parent price swing is down here, so we would pour a fib on those two price points. Okay, this low to this high. Optimal trade entry is just a little short of the order block. Stops are indeed ran out. Using this price high right in here with this low as your minimum threshold for order block here. There's your bullish order block here. Same scenario with stops above here. Runs into it during London Open. Let's move over so you can see a little bit better. Yeah, see. Optimal trade entry, again, falling short here. Okay, so we don't have it so much in confluence of optimal trade entry and order block itself, but all the other components are there, which is kind of like gets back to the notion that you're going to be in a gray area. You may not get all of the things lined up, but you still would have a lot of other factors that would, collectively give you a confluence for the trade. Remember, during this time frame in July, we had already worked the idea out that there's an USDX SMT divergence. In other words, the dollar was unable to make a lower low, and the cable had made a higher high. So we are seeing distribution and accumulation in the dollar, but distribution in the cable. So we are in a sell program. So any rallies after the 12 midnight or 5 GMT time frame, it would be viewed as a Judas swing. Okay, so the optimal trade entry, while it was short of it here, okay, it's short of it here, it doesn't change the fact that you would still be in a profitable position, because we're always using a minimum of 30 pip stop loss, going into the market, especially trading London. And just to give you a further view, even if we were using the parent price swing, which is this high to this low, and say you were doing your trade in here based on that assumption, returning back to this order block here, if you were getting short at the 62% retracement level in here, that would be right in here. That would be 170.78. Round that to the nearest round number. You got 170.80. Okay, you're inside the optimal trade entry, and you're also back inside this order block here, bullish candle, and it does run out this short-term high prior to it. So it does give you an ideal entry point there inside of London too, because this candle on the high comes in at 8:15 GMT, which is the heart of the London Open kill zone. Okay, and this one here, I'm tempted to go over the mitigation block, because there's a lot of examples of it in this section of market data that we're using to teach the principles that were used all throughout this year in 2014. Just know that this low back here will be talked about, and we'll just have to revisit it at that time. But for now, we're just going to say for a moment you didn't know anything about mitigation blocks. Okay, we're going to just assume that for now. And we can see clearly they have a low here, and the market had a nice little turning point in here. Okay, and we also have the bullish candle prior to the move lower, and we also have the body of the candle, this bullish candle as well. So this is a good level. Stops, if I can get this rectangle to work with me, would be just above this short-term high. And let's assume, again, the same thing. We have a high here, move prior to the drop, prior to the rally up, which is right there, this low. So it's this high to this low. This is the range. You pull your fib on. This is where you would be entering. Okay, right in here. So inside of this area right in here. This is London Open. This would be a good fill. You're also coming back and blowing out the stops here. Now, if your concern is, well, wouldn't I be stopped out there? No. And this is really what I want to kind of get at too. Once you have an understanding there's 30 pips. Right there's 30 pips. And say you're getting in right at the 62% tracing level, right there. Okay, your stop's up here, way up in here. Okay, and is not ran. So you can see clearly that it did offer some good reward to risk parameters for this particular day. Again, the idea is if you're looking for really, really, really good trade setups, because I'm not trying to teach you to trade every day. I don't trade every day. Okay, but if you're looking for really one good setup a week that really lines up, a good level of confluence of events and factors, this is one way that you could arrive at that goal. Now, you don't need to have all of them lined up to get a trade, but the more you have, obviously, the more cherry the setup. Okay, but ideally, what I want you to learn is that if you are anticipating a selling scenario, okay, you want to see a rally after the 5 GMT, or what we commonly call New York's midnight time frame, the short-term high prior to it, a rally above that, because they're going to take stops out. And once you see that, you'll see the market turn on the dime and go the other way. Short-term high here, the market rallies after 5 GMT, takes a dump. Okay, we start going into a consolidation in here. We're going to assume, say you lost money on this day right in here on the 28th. Well, the same scenario unfolds the very next day. You have a short-term high. We rally up into an existing order block. Okay. Sell it. Boom. Power 3. Okay. In here, same thing. Just got to look a little bit closer now. Okay. Yes, they have a high up here. The move after 5 GMT, okay, trades lower, trades lower, trades lower, trades lower. But then we got to go back and look at what's been going on prior to this move. And we'll talk more about this in volume 5. But right in here, there's something that's very, very influential in terms of price. Okay. And you can see a short-term high here. It gets ran out above this high here into a previous order block right in here. Let me draw that in there because I know some of you are thinking, it ain't there. See that? Boom. High of that candle is 169.40. The low of this candle, 169.40. Okay, so precision, precision, precision. Okay, but again, I know I'm probably driving you nuts by not talking about this, but it's in the next video, guys. Just relax. In fact, we're going to use these same examples, though, if that helps. We have a similar scenario here. We have a short-term high in here with the understanding that we expect lower prices. 5 GMT or midnight, we look for a rally up, take out those stops, returns to a previous order block. Okay, sell it. Boom. Okay. Same scenario here. We have a short-term high in here. Okay, early stops in Frankfurt. They gun it up higher, taking out the stops, returning to previous order block. Boom. Sell it. High probability. Consolidation. Say you lost money. No problem. People lose money sometimes. Same scenario here. Okay. Maybe you didn't have a trade here. Maybe you did or didn't. I don't know. Okay, but let's just say you didn't. I know I didn't trade here because this was the week going into my birthday, and I didn't do anything there. No trade there. Nothing would have been triggered on that. Okay, here's a nice one. We have bullish candle prior to move lower, midnight time frame, short-term high. Okay, notice it only needs a lower high on either side of it. Okay, and once it creates that, stops will build on that because it'll look like this to everyone at the time. That's a bear flag. Everyone's going to say, oh, it's classic bear flag. Look, it's found some resistance here. Okay. In fact, I'll draw a line, go back to this high here. Okay. And say, well, look, this is clearly resistance. It's in a bear flag formation. It's been dropping. So we're gonna sell it here and put a stop loss right above this price point here. You should be looking at this as a price high, okay, in this order block. And when it gets back up to minimum threshold of 168.54 after midnight, after it guns out these highs, this high, short-term stops, right in here, boom, you're looking to be a seller. Okay, and then the result is profitability. And then that same expected bear flag formation here did eventually materialize, but just wasn't able to pay those participants that were trying to take advantage of it then. Same scenario here, bullish order block prior to move lower. We have a short-term high in place inside of the price swing or range. You have an impulse move higher. Then have a minor retracement inside of it. Stops will build above this high. They gun it, boom, after midnight. Okay, into the order block, sell it, bang, right there. Lower prices as a result. Okay, you see the repeating theme? By having the higher time frame premise in mind, you'll know what they're going to do and where they're going to inject volatility and liquidity. The liquidity that rests above short-term highs in bearish markets is where they're going to gather up and collect and accumulate new shorts and knock out those participants that would have been profitable. Think about it. If those individuals that were short in here were never knocked out, they'd be profitable down here. You think the banks want that? No. You think the large institutions want that? No. You think your brokers want that? No. Okay, so all of those things are going against you as a trader, so you need to be thinking about that when you're taking your trades. Here's a day that you may have lost money again, and here's another day they say you would have lost money as well. Very next day we have price moving. Here's a short-term high. Here's midnight time frame. Now understand what we're looking at. Okay, we have a low here, and look at the high back here. This is why you want to look at your charts away, like turn your computer on, look at it, sit on the sofa, and have it sit on, maybe a coffee table across the room, and just look at it from a greater distance. Because again, if we start zooming in and only looking at the little minor moves like this, you're going to forget about these parent price swings like this high down to this low. And these are some of the things you need to be doing as you cycle through your time frames. Obviously, everyone has their pet time frames. You mind daily, 4 hour, 1 hour. But this is the price swing that you need to be aware of. This low, that high, back here. If you don't have that in mind, you won't ever see these events. Okay, where after midnight, price runs a short-term high where the stops are. Boom. Even in Frankfurt, we have double tops. Everyone calls this stuff in retail world, and it's just like a magnet for everyone to put their stop loss right above it. And you see that happening right in here. Boom. On this candle at 9:30 GMT, August 13th, 2014. Boom. Right there. Okay. That particular day, okay, would have been astronomical in terms of profitability. The parent price swing, you have an order block here. You have a very handsome order block right there, which actually lays right on top of the 79 concentration level, which is really good confluence. With that in mind, that particular level, it looks like it's around 168.42. Is that what that is? Yeah, 168.42. Round it to a round number, 68.40. That should be a good entry, and it's still very close in proximity to the low of that particular bullish candle, which is a bearish order block. So again, we could go on and on and on and on and give examples of where it did work and where it didn't, and still be if you took the positions on a weekly basis. You certainly can find and ferret out some really good and outstanding bullish and bearish order blocks. Now I gave you examples of the bearish side. Um, Everything is the same thing, just on the reverse. You're looking for a swing higher, and when there's a low, you want to see the lows blow out a short-term low where stops would be, and then it would continue higher. So everything you're seeing here on the sell side, just reverse it for the buy side, and that's going to take a little bit of homework on your part, and that's good. It's not all about me giving you cherry-picked hindsight perfect examples. I want you to look at the charts and see for yourselves across a numerous of pairs of currency pairs. In other words, looking at not just the cable, look at the fiber, look at the Aussie dollar, look at Kiwi, Canadian. Um, it's important that you understand it, and even the dreaded yen. I don't like it, but it works there too. I just don't like that pair. The all these concepts are there for you to be studying and building an ideal framework for how it works in the past and anticipate seeing it in the future. And again, that's where the learning takes place, seeing it unfold real time in your own charts, marking them up in advance, saying, okay, there's a high here, we're in a sell program, they're going to take the stops most likely and return to a previous order block, and at midnight we're going to see that Judas swing move higher, sucking everybody in on the wrong side of the marketplace, and then there you go. You see it taking place right there. And since it's a wonderful example here, I'm going to close this video on this point and encourage you to do your own study. Don't take my word for it. Look at the charts, study it, and when you start seeing these factors build upon one another and you get a greater confluence of things, you'll be able to build a greater trust in the order blocks that you're trading off of. And understand that the 30 pip stop loss is your shield, even though you may have the overall context correct. If you try to trade with too short of a stop, it can still be right in your directional premise, but be taken out nonetheless, and not see the profitability that would be available had you used the 30 pip stop. So until then, guys, until we move over to the fifth installment, I wish you good luck and good trading.